Welcome to TradeTheMBI.com. This is John. This report is for the 18th of March. Hopefully everyone had a good St. Patrick's Day. Well, we had seen that there was a slight fade, but we expected movements right around the APM, not as far as the 76%, but for at least the ES, for the NASDAQ, we expected a bit more weakness simply because the readings have been softer. We still are not getting any major short activity. Yes, we're in potentially the beginning of a DOC spread. That would create a little bit more weakness potentially. That could lead to further breakdown, and you can see shakeout getting close to negative. If it breaks to the negative side, that would definitely accelerate any kind of selling pressure that begins. You can see from a NASDAQ standpoint, we were well below the 25 with MBI Magenta and below yellow, and we had the brief spike of MBI white coming back above the 10 level. Actually, it was the first time in a while, and that was enough to cause the break of the 76%, but it had outpaced the S&P, so it's sort of evening out. And there's a lot of data that's going to be coming out again for the coming week. It's funny, JPM still projecting 3 rate cuts or 75 basis points for the Fed this year. And that sounds wonderful. Everyone would like to see that happen. But in the real world, of course, bond traders realizing that may be a little further off than they had hoped for because, oil now over 80 and rising. So that's an acceleration into the rate of inflation, because even if you get the rate of inflation to decrease, it's not going to mean a reduction in prices. There's still elevated prices everywhere. So, this is where they use semantics to confuse people as to how things are going from an inflation standpoint. And it's not getting any better. In fact, this is much worse. And of course, you see, you want to go track LNG shipments and oil through the Red Sea, and it's at 0. So that's a major disruption in supply, and that is going to have a material impact in time. And even with the workarounds, I don't see how they're getting through that. That is going to be a disaster for the euro as usual. The Eurozone is, as we've discussed, is not going anywhere from a positive standpoint, at least from a growth standpoint. If they have to pay more in dollars for oil in that, I guess they can always talk to the BRIC countries about getting cheaper Russian oil. That's not going to happen given the embargo and the increase in the embargoes. But gold fading back a little bit. It's got some positive extremes right all the way back to the beginning of the breakout here, but I wouldn't expect it to come back there, especially with what we're seeing from the oil standpoint. If that continues to rise, you would expect new highs out of oil. Likewise from crypto space as well, a little backing off from the peaks, and again, also a lot of positive extremes, but literally it's just a matter of following where the breakout goes. And I think you're going to get differentials like ETH fell back a little bit more simply because, like the NASDAQ before, it had gotten a little bit ahead of the pace relative to where Bitcoin is. And where gold was always the standard of just watching, the relative relationship between inflation, devaluation. These cryptos really bring it out into the forefront from particularly Bitcoin. You have a very limited amount at the 21 million range, and it's not going to change. And so that just becomes a very interesting perspective in the modern era of recognizing the difference between what's happening with money supply from a dollar standpoint and any other currency. It's not really been an issue because when every other currency is adding the same amount that you are, it becomes a relative blah. The differential is you have something like that isn't moving as far as supply goes, and you get to see the differential. And of course, this was always the theory with fractional banking. You know that you're going to generate inflation, and that is just built into that setup. And at a certain point, though, it starts to accelerate. And the fact that they don't have spending under control is the real issue. If there was a containment for the amount of deficit spending, and economically you could justify where you're going to some degree, and you grow out of it, much like there was panic in the 80s when we had a couple $100 billion total debt. And they were freaking out. It didn't take much growth at that point to do it, take care of it. And even by the mid 90s, you actually had budget surplus. But there's no real sense of controlling any of that at these days. And now, with the amount of government spending that you're doing, government employees, the disproportional take up of the actual economy is disproportionate. And without that government spending, though, you look at what the economic situation is, it's not pretty at all. And that's where, the disconnect between politicians versus average Joe, not in the same ballpark. You can see from our 50K standpoint, we just continued to move down, creating new zeros every time we get the MBI white spikes. Now you have magenta leading, so we're clean, probably up towards that 50% range. And from that point, we'll get a clear idea. The shakeout has turned positive after a pretty decent couple of days of solid negative there. Will it materialize? We talked about this. We would see this added volatility, but it was mostly just going to be a bouncing around, and particularly until we get some kind of definitive idea as to whether or not we're getting significant slowdown anywhere. That we knew that this was the time range that the interest rate increases would start to really bite, and getting a clearer idea of how much impact that will have, particularly when it comes to real estate and that, because that spreads over time, and the real effects of that you wouldn't really see until November if things start to escalate. I know we're already seeing credit card delinquencies rising, things like that. Those are the bellwethers, and usually you look at like the used car market and things. They're just empirical ideas to give you an idea of a trend, the starting point of something. So we'll keep an eye out for it. As always, keep a lookout for what's going on here. This is pretty clean. Pre-market started off the selling, and then by the time the actual open of that pre-market, and then a little bit of a bounce coming into the cash open, and that just faded off. And then by the end of the day, they kind of evened it out, split the difference. And here we are in the post-market. They've nailed a little bit of those shorts, forcing them to cover there in the post-market and building back up again, but it's all still in the same range. You're still over 5K, so it's just a little bit of back and forth and nothing traumatic. So as always, we'll just keep following it and let you know if anything relevant happens. I'll put it on the Skype chat. Have a good one. Trade well.